Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing ICE's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 86 billion market cap. They're trading at $150 a share and they have 570 million shares outstanding. ICE operates regulated marketplaces for listing, trading, and clearing derivative contracts. Its exchanges offer financial securities such as commodities, interest rates, foreign exchange, and equities. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looks good. It goes from 2.7 billion to 3.3 billion. Really good margins, 29 to 32%. I think anything above a 20% margin is pretty good. Free cash flow margin, that is. Net income is the profit or loss on the income statement. It's revenue minus expenses. That doesn't look as good. It goes from 4 billion down to 2.4 billion. Revenue is the sales for the company, and that goes up each year from 9.2 billion to 10.8 billion. And they pay a decent dividend, 1.2%. It cost them $1 billion. But they have 3.3 billion of free cash flow, so they can cover the dividend 3.2 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value of total cash flows past year 4, that's 94 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $84 billion. We divide that by 570 million shares. And we get a calculated stock price of 146. They're trading at 150, so they're trading at a 3% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 13 companies in the same industry as ICE, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, 600 million. Double number 2, Moody's. Their debt to equity ratio is equal to the median. For every dollar of equity, they have 80 cents of debt. Dividend is higher than average, 1.2%. CME Group is the biggest, 4.8%. They generate a little less free cash flow than CME Group, a good amount less than S&P. They rank second in market cap, a little ahead of Moody's, far behind S&P. They have a good price to book. They're trading at 3 times book value, but their PE and price to free cash flow are pretty close to the average. They're trading at 8 times revenue, which is better than S&P, also better than number 3, 4, 5, and 6. Look at QMCI, 0.2. They're such a small company, only 4 million market cap. ICE's revenue is 11 billion and they're still growing. Their 5-year annual revenue growth rate is 11%. Not as much as S&P, also not as much as MSCI or Morningstar. And they're tied with QMCI. If you put $10,000 into this company 10 years ago, you'd be pretty happy at $45,000 today, beating the market, a 16% annual return. So let me know what you think of the video, comment, subscribe. Thanks for watching.